If you had put $10,000 into a regular savings account 30 years ago and just left it there, you'd have a little more than $10,000 today. Maybe a few $100s in interest. That's it too. But if you'd put that same $10,000 into a simple S&P 500 index fund, something anyone could have done with a basic brokerage account, you'd have well over $150,000 today. Same amount of starting money, same 30 years. One decision made you almost nothing. The other could have changed your life forever. And here's the part that should actually bother you. The national average savings account today pays 0.38% a year, according to the FDIC. Inflation, according to the Bureau of Labor Statistics, is running at 3.4%. That means the safe place most Americans keep their cash is quietly losing value every single year. This video is not about get-rich-quick schemes, meme stocks, or secret formulas. It's about the actual, boring, documented math of how regular people build wealth through the stock market, using real numbers from the Federal Reserve, the IRS, and the SEC. Stick around, because by the end of this you'll understand exactly how to start, what accounts to use, and the mistakes that quietly cost beginners thousands of dollars. No hype, no predictions about what stock is about to moon. Just the documented history of how this actually works, and the exact numbers you need to make your own decision. Let's be honest about something most finance content won't say out loud. Investing is not complicated. It's made to feel complicated. Wall Street has an entire industry built around convincing you that you need a professional, a special strategy, or inside knowledge to participate. The truth, backed by decades of data, is much simpler. Buying a diversified basket of the largest U.S. companies and holding it for a long time has historically outperformed almost every other place regular people keep their money. Not guaranteed, not risk-free, but documented, decade after decade. That doesn't mean investing has zero complexity. There are account types to understand, tax rules to be aware of, and genuine risk involved. Your balance can and will go down before it goes up. But the core mechanism behind long-term stock investing is far simpler than the industry that's grown up around it would have you believe. This isn't advice telling you what to buy today. It's a breakdown of how the mechanism actually works, using verified numbers, so you can make an informed decision for yourself. Think about the last time you saw a headline about the stock market. It was probably about a crash, a crypto scandal, or someone who got rich overnight on a stock that later collapsed. Those stories get clicks because they're dramatic, but they're not representative of how most long-term investors actually build wealth. The boring version: buy a diversified fund, contribute regularly, don't panic, wait, doesn't make headlines. It just quietly works, decade after decade, for the people who stick with it. Here's the opportunity gap most people don't realize exists. According to the Federal Reserve's Survey of Consumer Finances, the most authoritative study of American household wealth, conducted every 3 years, 58% of U.S. families own stock, either directly or indirectly, as of the 2022 survey. That's a record high. But flip that number around. 42% of American families own no stock market exposure at all. And ownership isn't just about whether you're in or out. The same Fed survey found that direct stock ownership, meaning buying individual shares yourself, not through a retirement plan or mutual fund, jumped from 15% of families in 2019 to 21% in 2022. That's the largest 3-year jump on record, driven largely by the rise of commission-free trading apps. So the opportunity is real, and more Americans are stepping into it than ever before. But there's also a problem hiding underneath these numbers. A lot of people who do own stock don't actually understand what they own, why it grows, or how to avoid the mistakes that quietly erode their returns. That's what we're fixing today. There's also a generational piece to this worth naming. Younger investors, armed with commission-free apps on their phones, are entering the market earlier than previous generations often did. That's a meaningful advantage, because as you're about to see, the age at which you start investing can matter more than almost any other single factor in your outcome. It's not about being born into money. It's about starting the clock sooner. Let's start with the single most important number, in all of long-term investing. The historical average return of the U.S. stock market. Using the S&P 500, a market index maintained by S&P Dow Jones Indices that tracks 500 of the largest publicly traded U.S. companies, the average annual return since the index's launch in 1957 has been approximately 10.3%, including dividends reinvested. That figure comes directly from S&P 500 historical return data, compiled from the index's own performance record. Now, that 10% is a long-term average. It is not what happens every single year. Some years the index has climbed more than 30%. Other years, like 2022, it has fallen close to 20%. The average smooths out decades of both booms and crashes, including major downturns like the dot-com crash and the 2008 financial crisis. This is historical data, not a projection or a promise about the future. Compare that to where most Americans currently keep their emergency and short-term savings. According to the FDIC National Rates and Rate Caps data, the average U.S. savings account paid just 0.38% APY as of July 2026, a rate that has barely moved even through periods of higher benchmark interest rates. Meanwhile, the Bureau of Labor Statistics reported that the Consumer Price Index, the standard measure of inflation, rose 3.4% over the 12 months ending in July 2026. Do the math on that gap. A savings account paying 0.38% while prices rise 3.4% means your money is losing roughly 3 percentage points of its real purchasing power every single year, just by sitting there, untouched. That's not a risk you're avoiding by staying in cash. It's a guaranteed, slow loss you're quietly accepting. So how does stock investing actually turn a modest amount of money into significant wealth? Two mechanisms: ownership and compounding. When you buy a share of a company's stock, you're not lending money like you would with a bank. You're buying a tiny sliver of ownership in that business. If the company grows its profits, the value of your ownership stake tends to grow too. Many companies also pay out a portion of profits directly to shareholders as dividends. An index fund, like one that tracks the S&P 500, doesn't ask you to pick individual winners. It simply buys all 500 companies in the index, weighted by size. You own a tiny piece of Apple, Microsoft, Amazon, and hundreds of other companies simultaneously, all in a single investment. Most beginners don't invest a single lump sum. They invest gradually, out of each paycheck. This approach is often called dollar-cost averaging, investing a fixed amount on a regular schedule, regardless of whether the market is up or down that particular week. When prices are lower, your fixed contribution buys more shares. When prices are higher, it buys fewer. Over time, this smooths out the impact of short-term price swings and removes the pressure of trying to guess the right moment to invest. Now here's the part that makes long-term investing so powerful: compounding. When your investment grows and you leave the gains in the market instead of cashing out, next year's growth is calculated on the new, larger amount, including the growth from previous years. Your money starts making money on its own money. Let's run the actual math, using the historical 10.3% average annual return as an illustrative example, not a guarantee of future performance. If you invested $10,000 once and never added another dollar, growing at a 10.3% average annual rate over the long run, after 10 years, roughly $26,800. After 20 years, roughly $71,900. After 30 years, roughly $192,700. Now watch what happens if, instead of a single lump sum, you invest just $300 a month, every month, for 30 years, at that same historical average rate. Total money you actually put in, $108,000. Estimated value after 30 years, over $680,000. That gap, nearly $572,000, isn't money you earned by working harder. It's money the market generated on your behalf, simply because you gave it time. This is why financial professionals so often repeat the phrase, "time in the market beats timing the market." These are hypothetical, illustrative calculations based on a historical average rate of return. Actual results will vary and could be significantly lower or higher, depending on market conditions during your specific investing years. Let's illustrate this with two hypothetical investors, not real individuals, but realistic scenarios, built on the numbers we just covered. Investor A starts investing $300 a month at age 25. She keeps going, uninterrupted, until age 55, 30 years. Using the historical 10.3% average annual return, her account would be worth roughly $680,000 by the time she's 55, having contributed $108,000 of her own money. Investor B waits until age 35 to start. He also invests $300 a month, and also stops at 55. But now he's only investing for 20 years instead of 30. Using that same historical average, his account would be worth roughly $228,000, having contributed $72,000 of his own money. Both investors put away the same monthly amount. Investor A only started 10 years earlier, but her final balance is nearly 3 times larger. That's not because she was smarter or picked better investments. It's simply because compounding needs time to do its work, and she gave it 10 extra years. There's a third scenario worth considering too. Investor C doesn't start until age 45, but decides to invest more aggressively to catch up, putting away $600 a month, double what the others contributed, for the same 20 years until age 65. Using the same historical 10.3% average, her account would be worth roughly $438,000, having contributed $144,000. That's a meaningful outcome. But notice she had to contribute 33% more total money than Investor A, and still ended up with less. Time did more work than money did. This is why the single biggest lever most beginners actually have isn't which stock to pick. It's how early they start. Here's where beginners lose money without realizing it. Not through bad luck, but through fees and behavior. Expense ratios. Every mutual fund and ETF charges an annual fee, called an expense ratio, expressed as a percentage of your investment. According to the Investment Company Institute's 2025 report on fund fees, the average asset-weighted expense ratio for actively managed equity mutual funds was 0.40% in 2025. Compare that to index equity mutual funds, which had an average asset-weighted expense ratio of just 0.05% the same year, and index equity ETFs, which averaged 0.14%. That difference sounds tiny, but over decades it compounds against you, quietly and relentlessly. A fund charging 1% more per year than another fund, over 30 years, can quietly consume a substantial share of your total returns, not because the fund lost money, but because you were paying more for it every single year, and that fee also compounds. To make that concrete, imagine two identical $10,000 investments, both growing at a hypothetical 10% average annual return before fees over 30 years. One is in a fund charging 0.05%, the other in a fund charging 1.05%, a 1-point difference. The low-cost fund would end up worth roughly $169,000. The higher-cost fund would end up worth roughly $128,000. That's a difference of about $41,000 on the exact same underlying investment performance, purely because of what you paid to hold it. This is a hypothetical, illustrative example to demonstrate the mechanics of fee drag, not a prediction of actual returns. Behavioral mistakes. The data consistently shows that investors who panic sell during market downturns lock in losses that would have recovered if they'd simply stayed invested. The S&P 500 has experienced multiple double-digit percentage declines throughout its history, including in 2000, 2008, and 2022, and has recovered from each one over time, though recovery periods vary and are never guaranteed in advance. Not using tax-advantaged accounts. This is one of the most overlooked mistakes. If you're investing in a regular taxable brokerage account when you could be using a 401k or IRA, you may be leaving free tax benefits, and in some cases, free employer money, on the table, not knowing the difference between price and value. A stock's price falling doesn't automatically mean it's a bargain, and a price rising doesn't automatically mean a company is overvalued. Beginners sometimes chase whatever's moving fastest without understanding what's actually driving the price, which is a very different approach from buying a diversified, Rules-based index. Chasing individual stocks without diversification. Buying one or two companies you've heard about is fundamentally different from owning a diversified index. If that one company struggles, your entire portfolio struggles with it. Trying to time the market. It's tempting to think you can wait for the perfect moment to invest. Buy the dip, sell before the crash. In practice, consistently predicting short-term market movements is extraordinarily difficult, even for professional fund managers. Missing even a handful of the market's best days over a multi-decade period has historically had an outsized negative effect on total returns, which is part of why so many long-term investors favor a consistent, scheduled approach over trying to guess timing. None of this is financial advice telling you what to buy. It's simply what the data shows about where beginner investors most commonly lose ground. Let's put the key verified numbers side by side, so you can see the full picture at once. Where your money could sit. Average savings account, 0.38% APY, FDIC, July 2026. Average high-yield savings account, roughly 1.60% APY, Experian Curanos data, July 2026. Inflation, 12-month CPI, 3.4%. BLS, July 2026. S&P 500 historical average annual return, approximately 10.3% since 1957. S&P Dow Jones Indices data. What it costs to invest. Average actively managed equity mutual fund expense ratio, 0.40%. ICI, 2025 average index equity ETF expense ratio, 0.14%. ICI, 2025 average index equity mutual fund expense ratio, 0.05%. ICI, 2025 average equity fund expense ratio, inside 401k, plan specifically, 0.26% in 2024. What you can contribute, tax advantaged, into 4024, catch-up limit, age 50. An additional $8,000 for a total of $32,500 IRA contribution limit, $7,500. IRS, up from $7,000 in 2025. IRA catch-up limit, age 50. An additional $1,100 for a total of $8,600. Notice the pattern. The government has built entire account structures specifically to encourage long-term investing, with contribution limits that rise almost every year to keep pace with inflation. It's also worth noting how these pieces connect. If you contributed the full $24,500 401k limit for 2026 every year, invested in a low-cost index fund with a 0.05% to 0.26% expense ratio, and earned something close to the historical 10.3% average annual return, the combination of low fees, tax-advantaged growth, and time would be doing almost all of the heavy lifting, not any special stock-picking skill. That's the entire model in one sentence. Contribute consistently, keep costs low, and let time compound the results. So what does all of this actually mean if you're just getting started? First, understand the order of operations that most financial educators point to, based on how these accounts are structured under IRS rules. If your employer offers a 401k match, contributing enough to capture the full match is generally considered a priority, since it's an immediate, guaranteed return on that portion of your contribution that no market investment can match. After that, many people look at maxing out an IRA and then increasing 401k contributions further, up to the annual IRS limits we just covered. Second, understand that low-cost, diversified index funds exist specifically to remove the guesswork of picking individual stocks. Given that the asset-weighted average expense ratio for index equity mutual funds was just 0.05% in 2025 according to the ICI, cost is rarely the barrier it used to be. And this has only gotten more true as competition among fund providers has intensified. To put that 0.05% in perspective, on a $10,000 investment, that's $5 a year in fees. Compare that to an actively managed fund charging closer to the 0.40% industry average, $40 a year on the same balance. Both sound small in isolation, but scaled up over decades and compounded alongside your returns, that gap can meaningfully affect your ending balance. Third, And this is the part the data makes undeniable. Starting earlier matters more than starting with a large amount. Going back to our two hypothetical investors, the 10-year head start was worth more than doubling the final outcome. You don't need thousands of dollars to begin. You need time and consistency. Fourth, understand what account you're investing through matters almost as much as what you invest in. A 401k is typically offered through an employer and often comes with a matching contribution. A traditional IRA and a Roth IRA are opened independently, usually through a brokerage, and differ mainly in when you pay taxes. A traditional IRA generally offers a tax deduction now, with taxes owed on withdrawals later, while a Roth IRA is funded with after-tax money but can allow qualified withdrawals tax-free later, under IRS rules. The right choice depends on your current and expected future tax situation. This is general education based on publicly available data, not a personalized recommendation. Your own situation, income, debt, risk tolerance, and timeline will determine what's actually right for you, and that's a conversation worth having with a licensed financial professional if you want individualized guidance. Let's go back to where we started. $10,000 sitting in an average savings account for 30 years barely moves. $10,000 in a low-cost S&P 500 index fund, based on the market's historical average return, could grow into six figures. That's not luck. It's not a secret formula. It's the well-documented result of two things working together: ownership in growing businesses and the mathematics of compounding, given enough time to work. The Federal Reserve's own data shows that 58% of American families already participate in this system in some form. The question isn't whether the stock market can build wealth over time. The historical record on that is well established. The real question is whether you're going to give your money the time it needs to take advantage of it, or whether it's going to sit somewhere quietly losing value to inflation. Every year you wait is a year of compounding you don't get back. Not a year you can make up later by investing more. A year that's simply gone, permanently, from your total. That's the real cost of waiting, and it's the one number no headline ever puts front and center. Every number in this video came from a primary, verifiable source: the Federal Reserve, the IRS, the Bureau of Labor Statistics, the FDIC, and the Investment Company Institute. Not opinions, not predictions. Documented history and current, publicly available data. Past performance doesn't guarantee future results, and nothing in this video should be taken as personalized financial advice. It's education, based on the numbers, so you can make your own informed decisions going forward. If you want guidance specific to your own income, debt, and goals, a licensed financial advisor can help translate these general principles into a plan built around your actual life. If this broke down the math in a way that finally made total sense, subscribe now for more breakdowns like this one, because understanding how money actually works shouldn't require a finance degree. It just requires the real numbers, laid out clearly, and the patience to let them do what they've documentably done for decades.